Domestic economies often look healthy at the street level. Services remain resilient, restaurants are full, and local unemployment has not collapsed. This chart highlights a disconnect. Domestic services trend upward, while global goods volume plateaus and begins to slide. Manufacturing reinforces this signal. The global PMI is locked at 50, a holding pattern where firms choose to wait rather than expand or cut. This divergence allows local stability to mask a weakening global engine. While city sidewalks remain busy, the connections linking economies to one another are losing their momentum. Total global wealth remains intact, yet the focus of consumer spending has moved. Higher interest rates make it more expensive to finance the durable goods that dominate international trade: cars, appliances, and industrial machinery. Consumer demand has moved away from these globally shipped products in favor of localized services and experiences, creating a vacuum in the trade lanes. This shift leaves companies with a mounting problem: warehouses filled with inventory that was ordered before demand began to cool. To see how this stops a supply chain, consider a retailer expecting to sell 100 units, placing an order to match. If consumers buy 90, 10 units remain as excess stock. To clear that backlog, the retailer slashes the next order to 70 units. That 30% cut cascades backward. The factory reduces output, cancels raw material orders, and forces cargo ships to idle. Mathematical amplification turns a minor retail pullback into a significant logistical stall, effectively freezing the manufacturing and shipping sectors. This effect is visible globally. Major export hubs in China and the Eurozone show synchronized manufacturing weakness, signaling the stall isn't isolated. Logistics companies confirm this. Freight rates and shipping volumes remain soft across major trade lanes. Energy markets are reacting. With fewer goods moving, global oil demand expectations have been revised downward by nearly 1 million barrels per day. Currency markets provide a second layer of pressure. Emerging markets often see their currencies weaken as they attempt to maintain the competitiveness of their exports during a slowdown. A weaker currency makes exports cheaper, but simultaneously raises imported fuel prices and increases food costs, leading to higher domestic inflation. The trade slowdown now functions as an active feedback loop, where rising import costs erode the domestic purchasing power required to drive a recovery. Historically, trade acts as a multiplier. It allows nations to specialize their workforces and access the scale required to grow faster than their own domestic demand would allow. When this multiplier stalls, growth becomes uneven. Nations find themselves reliant on their own populations to sustain an economy that was built for a global market. While the initial slowdown was driven by inventory cycles, the persistence of the stall is now psychological. Because firms cannot predict pricing or future demand, they are delaying investments in new facilities and future capacity. This growing caution creates a long-term vulnerability. If demand returns quickly, the capacity needed to meet it may no longer exist, potentially leading to sudden supply shortages and further price spikes. If inventories remain high and businesses continue to wait, trade could stay subdued for years, placing a ceiling on global growth and weakening economic alliances. Conversely, once existing stocks clear, even a slight increase in orders would restart the cycle, lifting freight demand and reactivating the trade multiplier. The global economy remains in suspended animation, awaiting the specific signal of confidence to turn these cranes back on and restart the engine of trade.